18 straight months. China buying gold and silver as the price is getting destroyed. India doing the same thing as the price is getting destroyed. I mean, 14 billion in gold was delivered in June. Who the hell
That's right.
is doing that? You see it flowing to the biggest money in the world, who is prioritizing owning it, physical possession, in an inelastic manner, meaning they don't care what the price is, they don't care what the CPI is, they just keep accumulating it and repatriating it, removing counterparty risk. I think they have all settled on gold as a substitute for treasuries, and when you see China say, we don't care what the price is, we'll buy more silver than any time in the history of the country over the first 3 months, or someone here on COMEX physically take possession of 39 million ounces in February. When we look at a strong economy, is it strong, or is the stock market completely detached from Main Street? The household survey showed almost 500,000 people left the labor market. The Bureau of Labor Statistics lies about inflation and employment. Now, is it more of a K-shaped economy where the wealthy are getting wealthier and the poor are getting poorer in the face of higher inflation, cost of putting food on the table, driving to work, insurance, tuition? If you understand what is happening and can get in front of it and, minimize your exposure to traditional assets, or traditional forms of investing, and own physical assets in your own possession. It doesn't just have to be precious metals. I mean, it could be farmland, it could be agricultural ETFs, it could be oil and gas. Assets will feed you, liabilities will eat you. US dollars will not be the pathway to retirement. You can't hold a large portion of your wealth in US dollars right now, because I think the second half of the year we'll see massive inflation. I really do. They're going to do their best to try and hide it. You already see Fed Chairman Warsh saying he wants to go to a different metric of inflation that cuts off the outliers high and low, and puts inflation right now at 2.3%. I mean, come on.
Really? I mean,
but what gold
come
does,
on.
it snips out real interest rates. That would be a nominal rate, 2.3. Real interest rates would be that 2.3 that they pretend it to be real, factored into inflation as well, would push it much, much higher. So gold will sniff that out. Having your money in gold and silver right now, to me, independent of anything that I know as a company who's done this for 36 years, the biggest money in the world is showing you that this is the path that they're taking. We've seen deliveries. I mean, 14 billion in gold was delivered in June. Who the hell is doing that?
That's right. It's been crazy.
The Fed insists inflation is contained, yet institutional demand is behaving as if a different future is already unfolding. Andy Schectman notes that billions in physical gold deliveries are occurring while official inflation metrics remain reassuringly low, creating a striking disconnect. If major capital is prioritizing tangible assets over cash, investors should ask whether policy statements or institutional positioning deserves greater attention. For long-term savers, that gap matters more than headlines. Next, Andy Schectman reveals why real interest rates may be sending a completely different signal than policymakers admit.
18 straight months. China buying gold and silver as the price is getting destroyed. India doing the same thing as the price is getting destroyed. All of the countries, Poland bought more gold than anyone in the world, but more than anyone in the world for the last 2 years. So these central banks, who, by the way, the first quarter of this year bought more gold than in any time in the history ever in a first quarter. But the World Gold Council just came out and said, those numbers that you quoted of 16 tons, well, you underreported by 15 times. We see 244
You're kidding me. 15
No.
times underreported of how much gold was actually ordered?
That is the World Gold Council that just came out and said that. They said, no, we see by the import-export numbers, the central banks bought 244 tons, not the 16 tons they claim, which puts it at the highest number of the highest amount of gold ever imported in the first quarter ever. And this is as the price was getting destroyed. So the moral of this story, whether it be equities to the upside or metals to the downside, price is a tool of misdirection.
That's
so as
what
the
it
equity
is.
market goes up here, this shiny object that everyone's chasing, jammed into 10 stocks, you have the most well-informed money on the planet, whether it be the central banks en masse, whether it be China, whether it be whoever's handing the delivery here, buying more than they ever have in history in the first quarter,
Well,
as the price is getting destroyed.
Central banks keep accumulating gold even as falling prices encourage retail investors to look elsewhere. According to Andy Schectman, import data can paint a very different picture from widely reported official figures, raising questions about what institutions are quietly preparing for. When informed buyers steadily accumulate during weakness instead of strength, disciplined investors should pay attention to behavior rather than headlines. Next, Andy Schectman exposes why price declines and institutional demand may not be telling the same story at all.
The reason I keep saying wow is because it's so obnoxious. It's so in your face. It's so, I want people to understand how, from an economic standpoint, how incredible this is.
It's in our face, but most people don't know it.
I know. That's why I want people to understand this. That's why with the silver, it just is so incredible what we're watching.
It is incredible. It's something that I never tell people to own to become wealthy. It is wealth that has outlived 2 world wars and German hyperinflation and the Great Depression and all the pandemics, etc. But you see it flowing to the biggest money in the world, who is prioritizing owning it, physical possession, in an inelastic manner, meaning they don't care what the price is, they don't care what the CPI is, they don't care what anything is. They just keep accumulating it and repatriating it, removing counterparty risk. And at that level, when you're seeing billions of dollars worth move every month for 19 straight months, it's all you need to know. So they are siphoning as much as they can out using the Western system to their advantage. And now you have systems that are being built as of Monday in the global South to challenge price setting, where real price will be set not by futures but by cash and carry. Arbitrage will destroy the West's ability to suppress the price, and it's an existential threat at that point. And they've never had anyone to challenge the price setting. It's always been done here in the US and London. Not anymore.
Silver has survived wars and currency collapses because wealth preservation follows ownership, not optimism. What Andy Schectman is highlighting is that institutions continue accumulating physical metal, regardless of price, signaling priorities that differ sharply from retail speculation. Markets usually chase momentum, but sovereign buyers appear focused on eliminating counterparty risk instead. That divergence deserves far more attention than daily price swings. Next, Andy Schectman unravels why global price discovery itself may be shifting away from Western exchanges.
It's going to move to Dubai, Hong Kong, Shanghai, and other parts of the global South that value gold and silver and all, not just precious metals, base metals too. Remember, China bought the London Metals Exchange. That's the base metal part of the exchange system in London. They bought it, and they are warehousing most of the metals that are traded in London in warehouses in China. They understand, they play the long game. It'll be base metals, it will be rare earths. They already do most of the refining and manufacturing. They're setting themselves up to challenge the West, but not to replace it. And over time, maybe that happens, but no question about it, the West will find, I think, a growing challenger to price setting and to the wisdom of owning treasuries. And I think they have all settled on gold as a substitute for treasuries, which has performed better than the treasuries and can't be sanctioned away from you, or better yet, frozen the way they have with, in essence, default with the treasuries on Iran and Russia. Can't happen if it's gold in your own possession. So we're seeing this slow transition. The part that's hard for people to grasp is the length of time that it takes, and the lack of attention by the mainstream makes it easy to dismiss. But, you know, even with the pullbacks there that we've seen in silver, it's about double from what it was a year. So, you know, I think we'll see silver continue to move higher because the deliveries, as the price got destroyed, betrays the price.
Major financial shifts rarely happen overnight. They unfold while most investors dismiss them as isolated events. Andy Schectman's argument suggests the migration of commodity pricing influence toward Asia reflects a broader strategic transition rather than a temporary trend. If reserve preferences gradually move from treasuries toward physical assets, traditional portfolio assumptions could face lasting pressure. Next, Andy Schectman reveals why physical deliveries may matter more than quoted market prices.
And when you see China say, we don't care what the price is, we'll buy more silver than any time in the history of the country over the first 3 months, or someone here on COMEX physically take possession of 39 million ounces in February, billions of dollars worth, pulling it off the exchange where it will never come back. What are these people seeing that we're not? And that's really what I continually try to leave people with, that price is just misdirecting and tugging on your emotions. The public is jammed into equities at the highest degree of leverage, at the lowest level of price to earnings ratios.
It's incredible.
And the big money is saying, you know what, we're going to stand for delivery on metals instead. There is a dichotomy here that people should look at, that price is not reflecting. And
the most powerful people are holding the price down so that they can
stand for delivery.
You know what's sad? They're pumping the price of the market up, which earns them a ton of money, pushing the price down to metals so they can buy it at a low price. That's really that's kind of a sad thing. But one thing that you said is arbitrage. And, you know, arbitrage is something that the elite financial engineers used to talk about behind closed doors. And more people are talking about it normally and understanding it. And I think that's a pretty interesting development as well, because arbitrage is kind of how the elite financial engineers orchestrated things for decades.
Yeah, well, people are motivated by two things, greed and fear. And that greed is hard for the traders to ignore, that $85 spread between Western gold and Chinese gold, and 10, 11, 12, 13% on silver. Like 10, 11, $12 extra per ounce. On 10 million ounces that you deliver, that's $120 million profit. That is, and normally that type of arbitrage ends instantly as everyone flocks there. It's been going on for over a year as they're continually trying to siphon the metal away from the West. These are the things that are ignored by the mainstream that people can't understand because it's not in their face.
The fact that they're ignoring it is almost a crime, as far as I'm concerned, because it's the siphoning off a critical mineral or metal from our country, and they're just ignoring it. It's almost a crime for the media not to cover it, as far as I'm concerned.
That's exactly right. 100% agree with you.
Rising stock indexes can hide growing risks if institutional money is quietly accumulating different assets. This is where Andy Schectman's thesis shifts from price watching to ownership, emphasizing that sustained physical withdrawals deserve closer attention than short-term market sentiment. Wealth is protected by understanding where sophisticated capital is moving, not by following popular narratives. Next, Andy Schectman exposes why persistent arbitrage signals could reveal deeper structural changes.
But, you know, when we look at a strong economy, you know, I wonder, you know, playing devil's advocate, is it strong, or is the stock market completely detached from Main Street? The stock market's had a nice run, sure, but is the labor market really that strong? You know, we saw 50,000 jobs created on the last labor report, well under what we thought was going to be created. There are constant revisions, but that's issued by that's not the household survey.
That's really low, Andy. 50,000 jobs.
The household survey showed almost 500,000 people left the labor market. That's when the people in each house, rather than the labor report, which sees how many jobs have been created, payroll numbers have been created, payroll report. But the household survey asks you, Sarah, how many people in your house are working? And over 500,000 people fell off the list in the last on the last measurement because they're no longer considered unemployed. They've been unemployed for too long, so they just fall off. These numbers are exaggerated in many ways, just like inflation is. The Bureau of Labor Statistics lies about inflation and employment. And so I wonder, you know, is it more of a K-shaped economy where the wealthy are getting wealthier because of their exposure to equities, and the poor who don't have the ability to ride the stock market wave are getting poorer in the face of higher inflation, cost of putting food on the table, driving to work, insurance, tuition, all of these things that seem to be going higher and higher and higher.
Wall Street can celebrate record highs while millions quietly experience a very different economy. Andy Schectman notes that household employment data and payroll reports are telling increasingly different stories, raising legitimate questions about how economic strength is being measured. Markets respond to headlines, but long-term investors should pay closer attention to revisions and underlying trends that rarely dominate financial news. If Main Street continues weakening beneath the surface, portfolio assumptions built on optimistic narratives deserve another look. Next, Andy Schectman reveals why record stock prices may be masking growing systemic fragility.
So maybe we don't notice that big slowdown yet, but it seems when you look at credit card defaults, when you look at indebtedness, when you look at the labor reports, I would maybe slightly challenge that. It almost seems to me that people living on credit and struggling, whereas the wealthy seems to be doing much better in the face of equity markets to suppress interest rates and inflation, that creating a K-shaped economy where the rich get richer and the poor get poorer. I don't know. I would question that one, Sarah.
So you think we're in a recession like the rest of the world, and it's just a big illusion that
I do.
I'm thinking maybe so, because the rest of the world is just being honest, and ours is just this big illusion.
Right. No, I completely understand. So the information that comes out of the Bureau of Labor Statistics, the information that the president is espousing, isn't always really true. And in fact, it's slanted. And so, yes, I do. And not only that, even more dangerously, you have the public loaded into the stock market at the highest clip that they've ever seen, mob ever. And they also have the highest exposure to margin debt, which is about 1.6 trillion. So you have the public all in on stocks, all in on margin, which is speculating or leverage, and then all in on options exposure. So
credit stress usually appears long before recession headlines become widely accepted by the public. According to Andy Schectman, record margin debt and concentrated stock exposure have created an environment where confidence is unusually dependent on markets continuing higher. That isn't necessarily a prediction of collapse, but it does increase sensitivity to unexpected shocks. Investors protecting long-term wealth should recognize that leverage magnifies losses just as easily as gains. Next, Andy Schectman exposes why today's record optimism could become tomorrow's biggest vulnerability.
So you're all in on speculation, on leverage, and all in altogether, but these are the people who have stocks. And these are the ones that maybe aren't feeling it as much as everyone else. But what is the percentage of the public that owns stocks through 401k or IRA or whatnot? It's infinitesimally smaller than the actual number of households. So you have some people that seem to be feeling that they're doing well, but at the same time, you have all these people investing into 10 stocks. What could possibly go wrong? That is called breadth, BREDPH, where it's inverted. That market breadth is inverted to a point where you see any type of instability in the stock market. You think it's challenging now. Watch what happens when panic ensues, when, the investing public all in with no diversity on 10 stocks has a religious experience. That's when things get very crazy. But no, I would challenge that we are closer to a recession than people would think, simply because for most people, it's very challenging to keep things going and in this high cost inflationary environment. And we haven't arguably begun to see what inflation looks like. There's a lag time, and reigniting this inflationary war again, it's only going to make it worse, and it's going to make it longer as energy prices start to continue to rise, and the cost of inflation in funding this war will bear itself over the next coming months.
The strongest looking markets often become the most fragile when too much money crowds into the same trade. What Andy Schectman is highlighting is that concentration risk has quietly replaced diversification for many investors chasing recent winners. History repeatedly shows that crowded positioning can reverse much faster than confidence builds, especially when leverage is involved. Protecting wealth sometimes means preparing for outcomes the majority still considers unlikely. Next, Andy Schectman unravels why inflation's next phase could arrive after investors have already lowered their guard.
Over the third and fourth quarter, that lag time is going to start to show itself in ways that I think will challenge the thesis of the president that the economy is so strong.
Well, let me
Not
ask.
really happy that the war is reignited again the next.
Well, it's not factored in at all, as far as I'm concerned. It's still using the ratios to gold and all these things. It's just the money ratios, which is off that way as well. It hasn't priced in at all the industrial uses. So
Not only
it's the
that, it
weirdest
hasn't
product,
priced in the
period.
6 years worth of a structural deficit between supply and demand. So this is what happens when you have the proverbial tail, that being the futures exchange, wagging the dog, which is the physical market. What China is trying to do, I believe, by removing, as of July 24th, all of their citizens are no longer allowed to have futures contracts, and they're moving to a cash and carry system for their people, whereby real price discovery is at hand. I want to buy it. Thank you very much. Here's the price. Off you go. So, I think you can only hold the price down. Look, for years, the COMEX operated under an assumption that nobody wanted physical silver. They would buy the contracts to hedge exposure to mining or to inventory like mine. They would cash settle, or they would roll forward to the next delivery month, or they would exit.
Major repricing events usually begin long before markets acknowledge that supply dynamics have fundamentally changed. Andy Schectman's argument suggests years of structural deficits, and growing industrial demand may not be fully reflected in current precious metals prices. If physical trading gradually becomes more influential than paper speculation, conventional valuation models could face increasing pressure. Patient investors often benefit by watching where market structure is evolving, rather than where daily headlines point. Next, Andy Schectman reveals why physical demand could eventually overpower paper price discovery.
Less than 1% stood for delivery. When you see massive deliveries coming into the system, when you see deliveries that are leaving COMEX, where like in February, 26 million ounces were delivered to COMEX, but 39 million ounces left COMEX on trucks. That's 2.9 million pounds, $3-4 billion. Where did it go? Who has the ability to run logistics for that? Who's buying it? Money. Where's it going? Excuse me. So yeah, what overwhelms the paper suppression in my mind is physical demand that never happened until now. And it's not just on COMEX, it's all around the world. When the price got kneecapped, Sarah, during the first 3 months of this year, China imported more silver in the first 3 months than at any time in the history of their country. So big money that understands price is just a tool of misdirection is using it to their distinct advantage right now.
Price alone rarely tells the full story when physical inventories begin moving at unusual scale. This is where Andy Schectman's thesis shifts from futures pricing to actual metal leaving exchange vaults, a development that deserves careful monitoring regardless of short-term volatility. Sustained physical demand has historically mattered because ownership, not speculation, ultimately determines who controls scarce assets. Investors focused only on daily charts may overlook the broader structural trend unfolding underneath.